This video supplements the lecture for Chapter 6 on individual deductions. In this chapter, you will learn how to identify the common deductions that are necessary for calculating adjusted gross income. You will also be able to describe the different types of itemized deductions that are available to individuals. You're already aware of the standard deduction. And finally, you're going to learn how to calculate the deduction for qualified business income. To make sure we have a basis for understanding why the material in Chapter 6 is so important, let's take a look at the tax savings that exclusions and deductions can provide. Going back to Amani, let's assume that Amani has gross income of $49,700. Since he doesn't have, in our base case, an exclusion or a 4 AGI deduction, his adjusted gross income will also be $49,700. He'll take the standard deduction of $12,950, and after doing so, he'll end up with a federal taxable income of $36,750. We can go to our rate schedule for the single taxpayer and identify that Amani's going to be on the second row. Here, we can calculate Amani's federal tax liability by taking his federal taxable income of $36,750, subtracting out the bracket base of $10,275 to arrive at $26,475 worth of taxable income that's going to get taxed at the marginal tax rate of 12%. And that yields a tax on that $26,475 worth of federal taxable income of $3,177. We then add the cumulative tax. Remember, that's the tax that applies to all of the income that was taxed in lower tax brackets. In this case, it's $1,027.50 to arrive at his full federal tax liability of $4,204.50. We can also compute his effective tax rate by taking his federal tax liability of $4,204.50 and dividing it by his gross income, the $49,700. Now let's take a look at a case where Amani would have an exclusion from gross income. He still has gross income of $49,700 because gross income is all income from whatever source derived. So it doesn't matter that it's taxable or not taxable. It's all going to get lumped together in the gross income. Let's say of that gross income, $1,200 came from an inheritance. We learned in the last section of class that inheritances are excluded from gross income. So we would go ahead and remove that, and we would arrive at the AGI, or adjusted gross income, of $48,500. We would then remove our standard deduction and arrive at his federal taxable income of $35,550. We would then move back to the federal tax rate schedule, go to the second row, and compute his federal tax liability under this new scenario of $4,060.50. Finally, we can finish this off by calculating his effective tax rate, dividing the $4,060.50 by his gross income of $49,700. If we compute the difference between these two scenarios, we'll see that Amani has a total tax savings of $144. We could have estimated this without arriving at his federal tax liability. Because Amani's marginal tax bracket is 12% for the vast majority of his income, we could have also identified that the inheritance would yield a $144 tax savings by multiplying the exclusion by his marginal tax rate. Now that we've reminded ourselves about the tax savings that arise from exclusions, let's see how deductions affect our tax liability. In this case, let's assume that Amani pays student loan interest. Taxpayers who pay student loan interest are often allowed to deduct up to $2,500 per tax return of student loan interest. In this case, then, let's assume that Amani pays $1,200 worth of student loan interest. So he will take a 4 AGI deduction of $1,200, resulting in an adjusted gross income of $48,500. Since this adjusted gross income is identical to the adjusted gross income from the exclusion scenario, we know that his federal taxable income would be $35,550, that he would owe federal tax of $4,060.50, and his effective tax rate would be the same. If the exclusion amount and the 4 AGI deduction are the same, then Amani's going to still receive $144 worth of benefit because his tax liability will be lower than it is in the case where he did not have an exclusion or a deduction. Since this chapter also covers from AGI deductions, let's see the tax benefits that would be yielded using a from AGI deduction. In this case, Amani's gross income will still be $49,700, and since he has neither an exclusion nor a student loan interest deduction, his adjusted gross income will be $49,700. The big difference here is that Amani's going to take his itemized deductions of $14,150 because they're bigger than his standard deduction. The difference between these two is $1,200. So his federal taxable income is still $35,550. And his federal tax liability and effective tax rate will be the same as if he had received an exclusion or a 4 AGI deduction. In all cases, we can see that Amani has saved $144. However, what he had to spend in order to get that tax savings is different across all three scenarios. In the first scenario, Amani didn't have to spend any money. He was able to receive that $1,200 inheritance, and he did not have to pay tax on it because of the exclusion provision. So he saved $144 in taxes. The other two scenarios required him to spend money in order to receive that benefit. In the first case, he spent $1,200 in student loan interest. Because his AGI was sufficiently low enough, he was eligible to take all $1,200 as a 4 AGI deduction. But he still spent $1,200. So while he reduced his taxes by $144, his net cash outflow for the interest on the student loan would still be $1,056. In the last scenario, Amani needed to have itemized deductions that exceeded the standard deduction of $12,950. That means somewhere along the lines, he had to spend $14,150. In this case, I'm keeping it simple and suggesting that he spent it all on mortgage interest. That $14,150 paid to the lender for the mortgage interest only reduced his taxes by $144. So his net cash outflow for the mortgage interest is going to be $14,006. So just to recap, while his tax benefit from these three provisions are identical, the amount he had to spend is vastly different in order to achieve those amounts. Now, that's not to say that he shouldn't incur student loan interest if he wants to get an education, or he shouldn't incur a mortgage if he wants to purchase a home. Instead, this is just to point out the reality that the tax savings yielded by these provisions are often dwarfed by the cash outlay that you must make in order to yield those tax benefits. Now that we understand how deductions can benefit taxpayers, let's get into the types of deductions that taxpayers are allowed. In general, we can lump deductions into two categories: for AGI deductions and from AGI deductions. For AGI deductions are generally preferred to from AGI deductions for three primary reasons. First, as we saw in Chapter 5, the modified adjusted gross income, which is the gross income without considering taxable Social Security benefits, is used to compute how much Social Security benefits are taxable. Additionally, from AGI deductions may not yield a tax benefit. This will occur when itemized deductions are less than the standard deduction, and as I've noted in class, that applies currently to about 83% of taxpayers. Finally, adjusted gross income is used to limit the itemized deductions and some of the credits that you can receive. There are three basic categories of deductions for AGI. Those deductions that are directly related to business activities, deductions that are indirectly related to business activities, and then deductions that subsidize specific activities of taxpayers. Before we can review the deductions, let's cover what exactly is a business activity. In brief, in order for the tax code to consider an activity to be a business activity, it must be profit motive. Additionally, you must be actively engaged in making that money, which means you go to work every day or you materially participate in the business activity. If you don't have a profit motive, then you could still be actively engaged, but it would not be considered to be a business activity. Alternatively, you can have passive activities, which is when your money makes money for you. If you have a profit motivation for that passive activity, then it's generally an investment, such as buying bonds or stocks or collecting an old car or some other type of antique that you think will appreciate in value. Additionally, you can also engage in passive activities where you don't intend to make any money. For example, you purchase clothing or a car that you're going to use as a daily driver. Now that we understand the various activities, let's look at the types of deductions that are available. If you engage in a business activity, again, meaning that you're actively engaged and you have a profit motive, then you will get a deduction for AGI for self-employed business expenses. Since you already are getting the benefit of a for AGI deduction, your business activities are not eligible for a from AGI deduction. There are some activities that would not be deductible by the business taxpayer. These would include unreimbursed employee business expenses. And this makes sense because if you did not actually incur the business expense, meaning you made your employee pay for their own business expense, then you should not be entitled to a deduction on your tax return. In the case of a passive activity, an investment activity, you can also generate deductions for AGI for rental and royalty expenses. You're also eligible for deductions from AGI for investment interest expense. There are many other investment expenses that are not deductible. Finally, if the activity is considered to be personal, then you are very limited in the for AGI and from AGI deductions. In essence, Congress provides very few gifts with respect to personal activities. Most of the expenses and personal use asset losses that you incur are not going to be deductible. We've already seen a few examples of these, such as when we were reviewing the car, where we said Amani couldn't deduct a loss on his personal daily driver car. Likewise, you're not eligible to deduct losses on homes. However, if you do make money, then you can expect that you're going to have to include them as part of your taxable income. Now that we have a general sense about the different types of activities and whether they're going to result in a for, from, or non-deductible outcome, let's get into the specifics regarding deductions directly related to business activities. In general, you are permitted to deduct all ordinary and necessary expenses incurred in your trade or business. We're going to cover the concept of ordinary and necessary in more detail in Chapter 9. For now, all you need to know is that deductible expenses must be appropriate and helpful for generating a profit. We place all of our business activities from sole proprietorships onto a Schedule C. As you can see, the Schedule C has locations for the name of the business owner, as well as the name of the business and the location of the business. Most individual taxpayers are going to use a cash basis accounting method. And here we see question G asks whether you materially participated in the operation of the business during 2022. This question is specifically getting at the notion of whether you are actively engaged in making the money that the business is generating. As we scroll down, Part 1 asks questions regarding the various types of income that are generated from the business. So it wants to know, what are your gross receipts and sales? What were your returns and allowances? What was your cost of goods sold? And that gives you your starting point of your gross profit from the business. Then it asks about any other type of income before arriving at the gross income that's reported on line 7. Next, in order to arrive at taxable income, we can take our for AGI deductions. Instead of reporting the for AGI deductions on the face of the 1040, the Schedule C also has a Part 2 for you to list out the various ordinary and necessary expenses incurred in your business. And as you can see, it lists out a variety of common, ordinary, and necessary expenses for businesses, such as advertising, vehicle expenses, commissions and fees that you might pay, contract labor, depletion and depreciation, employee benefit programs, insurance, interest, mortgage, legal and professional services, office expenses, pension and profit sharing plans, rent or lease of either vehicles or other business property, repairs and maintenance, supplies, taxes, travel and meals that you incurred to send employees places, utilities, wages, and other expenses. Well, this covers a lot of expenses. There's also expenses associated with the use of your home. I will caution you, and we'll revisit this in Chapter 9. The IRS has been recently very critical with respect to this particular line item expense. After taking all of your expenses that are ordinary and necessary, you arrive at net profit. And as you can see, we're going to report the net profit from the business on Schedule 1, line 3, and on Schedule SE, line 2, where SE stands for self-employment income. We'll see this in just a minute. The backside of the Schedule C asks for particular details with respect to the cost of goods sold, as well as information on a vehicle. This latter piece is requested because so many people use their cars for both business and personal use. Now that we've covered the various business expenses, let's also see what we can deduct with respect to our rental and royalty income. Here, rental and royalty income is reported on Schedule E. Part 1 of Schedule E covers the income or loss from rental real estate and royalties. It wants to know, what is the physical address of the property that you're generating income from, what kind of property it is, and if you used it for both rental and personal use, such as a vacation home, then it wants to know the number of days that you split between those that it was actually rented out for profit and those that you utilized it. We also have a spot to list the various income that was received, whether it be from rents or royalty, as well as the common expenses that are incurred in generating the rents and royalty. Similar to Schedule C, we can see that there's common expenses that are likely ordinary and necessary, such as advertising, automobile use, cleaning and maintenance, insurance, management fees, repairs, supplies, taxes, utilities, and so on and so forth. Once you've identified all of the income and the expenses, you can determine whether you have a net income or loss from the rental activity. Note, rental activities by definition are considered to be passive activities, and therefore any loss that may be generated by a rental activity is typically limited. As we can see at the bottom, once we've computed our rental, real estate, and royalty income or loss, we're going to report this amount on Schedule 1, line 5. Now that we've covered the 4 AGI deductions available for business, rental, and royalty activities, let's briefly discuss the 4 AGI deduction allowed to taxpayers for their losses on dispositions of personal investments. This is another topic that we're going to discuss more fully, in this case in Chapter 7. For now, just remember that a taxpayer's net capital loss for AGI deduction will be limited to $3,000 per tax return per year. Well, this is the loss that is allowed to individual taxpayers on their personal investments. The loss rules for business property dispositions are a little bit broader. In general, businesses are permitted to deduct losses on their business property dispositions. Let's cover an example of this. Let's say that a business purchased a used car in August 2022 for $13,800. The business took $5,000 in depreciation on this car for 2022. We can find the adjusted basis by subtracting the depreciation from the purchase price. So if we do that, we would find that the adjusted basis would be $8,800. Now that we know the business's adjusted basis, let's assume that in 2023, they used the car as a trade-in to gain a different car. The dealership provided $3,500 worth of value on the used car as the trade-in. And the question is, what is the gain or loss on this transaction? Well, in this case, the amount realized from the trade-in of this vehicle was $3,500. Our adjusted basis, again, was $8,800. So the business realized a loss of $5,300. The business can take a 4 AGI deduction for this realized loss. Remember, if this had been a personal use asset, then there would be no loss that would be recognized on the tax return. While businesses can generally deduct losses on business property and losses incurred in operating the business, you should know that there are several important limitations on the losses that can be recognized. First, with respect to rental activity, this is again considered to be, by definition, a passive activity, and the tax code limits the loss that can be recognized on rental activity at $25,000 per year. This loss would be taken as a 4 AGI deduction and can be used to offset ordinary income from other activities. There are also additional basis, at-risk, passive activity loss, and excess business loss rules that can apply. Let's talk more in depth about the excess business loss limitation. The excess business loss limitation applies to all business losses. The primary rule seems fairly straightforward. Business taxpayers who file on a 1040 are limited to claiming $270,000 worth of loss per year. If the taxpayer is married filing joint, then they can deduct up to $540,000 worth of a business loss per year. Any remaining amount would be carried forward to the following year. So let's review an example where we have a married couple that has been operating a Schedule C business for a couple years now. Let's assume that the business generated $5 million worth of taxable income in 2021, and it generated $500,000 worth of taxable income in 2022. But the business suffered a loss of $3 million in 2023. The excess business loss rules require that the taxpayer limit the loss recognized in 2023 to $540,000. The remaining $2.46 million worth of loss will be carried forward to offset any positive taxable income that is generated in future years, and each year that the loss continues to exceed the taxable income, they will go ahead and take another $540,000 worth of loss. So let's carry this example forward to see how this works. They recognize $540,000 worth of the $3 million loss in 2023. They carried forward $2.46 million worth of that loss to 2024. If they generate $160,000 worth of taxable income in 2024, then they will use that loss to offset that $160,000 worth of taxable income, and they can recognize another $540,000 worth of loss in 2024. This means that after 2024, the taxpayers will have another $1.76 million worth of loss that they need to carry forward to a future period. Continuing our example, if the taxpayers make $1 million worth of taxable income in 2025, then they will again use that loss carry forward to completely offset the $1 million loss, and then they will be able to recognize an additional $540,000 worth of loss in 2025. This would leave them with a $22,000 loss carry forward. Let's assume that in 2026, they generated $200,000 worth of taxable income. In this case, they'll use the remaining $22,000 loss, and they'll offset that against the taxable income so that the business would only report a net taxable income of $178,000. At this point in the video, you should have a pretty good idea about the deductions that are allowed directly related to business activities. So let's go through some deductions that are indirectly related to business activities. The first one we'll discuss is moving expenses. It used to be the case that all taxpayers who moved for a job could deduct their moving expenses. However, beginning with the Tax Cuts and Jobs Act, a taxpayer who moves for their job and incurs the expenses associated with moving will not be able to deduct that expense. There's a limited exception for moving expenses for active duty members of the armed forces. So if we are advising these individuals and they need to move for their active duty responsibilities, then they would be allowed to deduct the moving expenses incurred and not reimbursed by the military. Sometimes employers will offer relocation packages. If your employer reimburses your moving expenses, then you will record the amount reimbursed as income on your federal tax return. Another deduction that's indirectly related to business activities is when a self-employed taxpayer pays for their own health insurance. Here, any premiums paid for the taxpayer, spouse, dependents, and children under the age of 27 are deductible as a 4 AGI deduction on the 1040. You can't use a health insurance premium to drive your business income below zero. So the maximum amount that you can deduct as a 4 AGI deduction for health insurance is limited to your self-employment income that was derived from the specific trade or business. Now let's talk about the self-employment tax deduction. Before we get there, I just want to remind you about employment taxes in general. When it comes to employment taxes, the employer pays 1/2 of the employment taxes. This would be your Social Security at 6.2% and your Medicare for a total of 7.65%. When you're an employee, you will also pay 1/2 of your employment tax. If you're a self-employed individual, meaning that you're a contract employee, you receive a 1099, you have to pay both halves for being both an employer and an employee. You are, however, eligible for a 4 AGI deduction if you're a self-employed individual. To see how this works and to identify the tax benefit, let's take an example. Amani can make $7,000 as a part-time football instructor. What is Amani's net self-employment tax on this income if all of his other wage income is $46,500? To figure this out, we would move to a Schedule SE, the self-employment tax schedule. The first part of this is to put on Amani's name and his identification. Then we can begin to fill out Part 1 of Schedule SE. Here, we would take his $7,000 that he received as a contract employee and report it on line 2 for the net profit from a Schedule C. Line 3 is a subtotal that asks us to combine lines 1A, 1B, and 2. Line 4A says that if line 3 is more than 0, we have to multiply it by 92.35%. So when we do this, we are going to enter $6,464.50 on line 4A. Then we can move down to the subtotal line on 4C, which asks us to combine lines 4A and 4B. Since employee doesn't have church employee income, we can then also create our subtotal on line 6, which asks us to add line 4, 6, and 5B. As I mentioned previously, when we were discussing regressive taxes, Social Security only applies to the first $147,000 worth of wage income for 2022. So the next portion of Schedule SE wants to check about how much your complete wage income is, considering both your self-employment income as well as your other wage income. Here, we would enter $46,500, since this would be the wage income reported in Box 3 of our Form W-2. We then subtotal this amount with any amount that needed to be reported on lines 8B and 8C. Line 9 asks us to subtract line 8D from line 7. In this case, we would have another $100,500 that Imani could earn before he does not owe Social Security tax. Line 10 tells us to multiply the smaller of line 6 or line 9. Since 6 is clearly smaller in this case, we'll multiply the $6,464.50 by the 12.4%, and we're going to report $801.60 as our Social Security tax due. We then determine the Medicare taxes owed for both the employer and the employee on the self-employment income by multiplying line 6 by 2.9%. Adding up our Social Security tax and our Medicare tax, we find that Imani will owe $989.07 of self-employment tax on the $7,000 he earned as a part-time football instructor, being paid as an independent contractor. We can see that the $989.07 will be reported on Schedule 2, line 4, which reports our other taxes that will be owed. So we'll owe this and pay it at the time that we file our 1040. Imani is also entitled to a deduction of 1/2 of his self-employment tax paid. So he will find this amount by multiplying line 12 by 50%, and then he will report the $494.54 on Schedule 1, line 15, as a 4 AGI deduction. So that we fully understand the difference between wages and self-employment income, let's assume that Imani has two options. He could work for one football club and earn $7,000 and be an employee, or he could work for a different football club and be an independent contractor, also earning $7,000. In both cases, his gross income from both his regular job and his part-time work as a football coach would yield him $53,500. He only receives a 4 AGI deduction of $494.54 when he's an independent contractor. This means that when he chooses the position where he is self-employed and receives the 1099, he will actually have a lower adjusted gross income of $53,005.46 versus the scenario where he was an employee of the organization. He will take the standard deduction in both cases. And here we'll see that he has both a lower taxable income and lower income tax when he is a self-employed independent contractor. However, Amani is going to have to pay both portions, the employee portion and the employer portion, on his self-employment income. And that's going to cause him to incur another $989.07 of self-employment tax. In the case where he's an employee, he's only going to have to contribute the employee portion of it, 7.65%. His employer will pick up the other 7.65%. So even though he received a 4 AGI deduction, his AGI and his taxable income and his income tax were lower. Amani will actually have less total tax paid as an employee earning $7,000 than he would as an independent contractor. To help fully illustrate this point, we can compute the marginal tax benefit received from the 4 AGI deduction of the half of the self-employment tax. His employment tax paid under the self-employed contract position is net $453.57 higher than what he paid as an employee. Again, because the employer, when he's an employee, picks up the other half. We can use that tax benefit to partially offset the employment tax that Amani owes as the employer. This means that he has a net tax increase of $394.23 when he's self-employed, earning the same amount relative to being an employee. The deduction that's indirectly related to business activities that's discussed in your book is the deduction for individual retirement accounts. As we've talked about multiple times in this class, Congress is motivating taxpayers to save for their own retirement. To accomplish this, they provide employees with two options for saving for retirement, using a 401k or a traditional IRA. Both yield a 4 AGI deduction, but whether they appear on our tax returns is very different. Let's assume that Amani has gross wages of $54,000 and he wants to make a contribution of $4,500 to either a 401k or a traditional IRA. We can use the tax formula to see the tax benefit. In the case of the 401k, he would take his gross wages, take a 4 AGI deduction, and then arrive at his adjusted gross income. The tax formula looks the same in the case where he contributes to a traditional IRA. So let's work through this example. We'd take Amani's gross wages of $54,000 and subtract off $4,500 as a 4 AGI deduction for his contribution to the 401k. This would leave him with adjusted gross income of $49,500. While the tax formula looks like this, you should know that the W-2 is going to look a little bit different. In the case of the W-2, since the contributions are being made through the employer will only report the net wages, meaning the wages after subtracting out the 401k contributions. We will see the gross wages reported for both Social Security and Medicare purposes. And the difference between these two, that $4,500, reflects the 4 AGI deduction permitted for 401k contributions. When it comes to reporting this information on the tax return, then, since we don't have gross wages, we're going to report the net difference on 1A. So the contribution to the 401k is still a 4 AGI deduction. It reduces our taxable income before we calculate AGI. But we actually won't see that on our tax return because it was already taken out by our employer before they reported our net wages in box 1 of our W-2. On the other hand, contributions to a traditional IRA are typically made directly by the taxpayer. Here, the tax formula is going to look identical. We're still going to receive that 4 AGI deduction. But when it comes to the W-2 and reporting the information on the 1040, we're going to report the gross wages of $54,000. Then we would go to Schedule 1, Part 2, and we would go to line 20 to report the IRA contribution of $4,500. By the bottom of Part 2, we find our adjustments to income. These are our 4 AGI deductions. If this is the only 4 AGI deduction that Amani has on Part 2 of Schedule 1, then line 26 will also reflect the $4,500, and we'll follow the instructions to report the $4,500 on line 10 of our 1040. When we carry that forward to line 10, then we can see that it reduces our adjusted gross income because line 11 tells us to subtract line 10 from line 9. So just to recap, regardless of whether Amani chooses to contribute to a 401k or a Roth IRA, the net effect is that his adjusted gross income is going to be $49,500. If we're using the tax formula, they will look identical. However, if we're reporting this information on our 1040, then the W-2 will have already removed the 401k contribution, so we won't see the 4 AGI deduction from the 401k contribution. But if we make the IRA contribution, then we report it on Schedule 1, and that carries forward so that we will see the 4 AGI deduction on our 1040. I've already mentioned in class that in addition to contributing to either a 401k or a traditional IRA, you could also contribute to an HSA or a health savings account. A health savings account should not be confused with a flex spending account. The flex spending account is an account where you can contribute money on a pre-tax basis so that it can be spent within about a year. So you would use a flex spending account when you have planned medical expenses happening in a particular year. A health savings account, on the other hand, is really a retirement vehicle to promote individuals to save for the largest costs that people typically incur in retirement, which is medical expenses. Just like other retirement vehicles, you have a wide variety of investment options for money that you would contribute into a health savings account. It's not a flex spending account, so you don't have to use that money within a certain period of time. Instead, the health savings account is intended for you to be able to save for medical expenses that you're actually going to incur after you retire. In order to be eligible to contribute to a health savings account, the taxpayer must be enrolled in a high deductible insurance plan. If a taxpayer is eligible to contribute to a health savings account, you should know that you actually get double tax benefits on your contributions. First, your contributions are 4 AGI deductions, so they act a lot like the traditional IRA or the 401k that we just saw. In addition, as I've already said, the contributions can be invested like other retirement accounts. So you can invest these funds in stocks, bonds, and so on and so forth. But when you go to take the distributions out, if you use the distributions to pay for qualified medical expenses, those distributions will not be taxed. This means that under the best case scenario, you get the tax benefit from the contribution side. So you get to reduce your current taxable income. And the money that you put into a health savings account will grow tax-free like a Roth IRA, as long as you use it for qualified medical expenses. That double tax benefit means that the health savings account is the most efficient retirement tax savings vehicle. Again, however, you have to be enrolled in a high deductible insurance plan in order to take advantage of this. There may be points in your life where it is more advantageous or less risky. In addition to that requirement, your contribution will be limited to $3,650 for an individual or $7,300 for a family per tax year. Let's say that you have a surplus in your health savings account when you're retired. Well, then what happens? In the worst case scenario, if you make draws from your health savings account, but you don't use them for medical expenses, then they're going to be taxed as ordinary income, which means in the worst case scenario, the health savings account looks and works just like a 401k or traditional IRA. But again, under the best case scenario where you're taking the draws for medical expenses, you get the double tax benefit of contributing tax-free and drawing money tax-free out of the health savings account. We can see the 4 AGI deduction on Part 2, line 13 of Schedule 1. The final 4 AGI deduction, talked about in Chapter 6, is classified as a deduction that subsidizes specific activities. More directly, this 4 AGI deduction allows taxpayers to deduct the interest that they pay on qualified education loans. Congress recognized that not all taxpayers could afford to go to college and pay out of pocket. Therefore, they sought to encourage people to go to college, even if they had to take out loans, by offering a 4 AGI deduction. The 4 AGI deduction, available for qualified education loan interest, is limited to $2,500 per tax return. In addition, Congress has chosen to phase out the available deduction based on the level of income that an individual earns. To help illustrate this point, I've created an example where Amani took out $65,000 worth of student loans in pursuing his undergraduate and graduate education. He incurs an interest rate of 6% on the loans. In 2022, he paid $3,766.90 in interest and $4,892.66 in principal on this loan. The question asks what tax benefit Amani will receive if his income is, and you can see we have income ranging from $70,000 all the way up to $85,000. In case you're interested in understanding what your interest payments would be and how much your principal payments would be for various loans, I've included a link to a loan amortization calculator at the bottom of these slides. Let's start with the first example, where Amani makes $70,000 worth of gross income. If he has no other 4 AGI deductions, then his modified adjusted gross income will also be $70,000. Amani paid $3,766.90 in interest and $4,892.66 in principal on the loan. He's eligible for a $2,500 4 AGI deduction on the student loan interest paid. Once we remove this from his gross income, we find that his adjusted gross income would be $67,500. He still gets the benefit of his standard deduction of $12,950, so his taxable income would be $54,550. We could use the tax rate schedule to compute Amani's federal tax liability. We would take his $54,550 worth of taxable income, subtract out the bracket base, find out that he has $12,775 of that taxable income, subject to the 22% marginal tax rate, yielding a $2,810.50 tax bill on that $12,775. We'd add in the cumulative tax of $4,807.50 to account for the first $41,775 worth federal taxable income, to come up with his ultimate federal tax liability of $7,618. However, all we're really interested in, because we want to know what the tax benefit of this 4 AGI deduction is his marginal rate of 22%. So we go ahead and grab that marginal tax rate, and when we multiply the $2,500 4 AGI deduction by his marginal tax rate, we find that the tax savings on the student loan interest deduction is worth $550. When we subtract that from the student loan interest paid, we find that he has a net outlay of $3,216.90. This goes back to our original example, where I pointed out that in order to obtain tax benefits using either a 4 AGI or from AGI deduction, the taxpayer will have to outlay more money than they receive in tax benefits. Now, in this particular case, Amani's modified adjusted gross income is such that he was able to take the full 4 AGI deduction. However, when we get to the second case, we'll see that the allowable deduction is reduced because Amani's modified adjusted gross income exceeds the threshold of $70,000 for single taxpayers. To find out how much we had to reduce the 4 AGI deduction by, we would take the $74,500 MAGI and subtract out the base, and then we would divide that by the total $15,000 range for which the student loan interest deduction is phased out over. This would yield $4,500 divided by $15,000. which equals a 30% reduction percentage. Next, we want to multiply the $2,500 student loan interest deduction by the amount that we're allowed to take, which would be the difference between 100% and the reduction percentage of 30%, or 70% times 2,500. And we find that Amani is eligible for a $1,750 for AGI deduction. This $1,750 for AGI deduction will yield him a $385 tax savings, thanks to him being in the 22% marginal tax bracket. And he would have to pay a net student loan interest of $3,381.90. So he still receives a tax benefit, but because he has high MAGI, he's going to have some of that tax benefit reduced. We could continue this example. So let's look at the case where he has $79,750 worth of MAGI. Again, we'd subtract out the base of $70,000, divide by the range of $15,000, and find out that he now has a 65% reduction percentage. When we multiply his $2,500 student loan interest deduction by the difference between the 100% allowable and the reduced percentage, we find out that he can now only claim 35% of that $2,500, or $875. Here, he would have a tax savings of $192.50, leaving him with a net student loan interest payment of $3,574.40. I've given you a couple more examples so that you can continue to see both the phase out of the student loan interest deduction, as well as practice this on your own. The student loan interest deduction is reported for tax purposes on Schedule 1, Part 2, line 21. I hope that you found this video helpful in understanding your options when it comes to 4 AGI deductions. As you can see, they definitely do provide a tax benefit. However, as we've mentioned a couple times throughout this video, the tax benefit by 4 AGI deductions requires that a taxpayer spend money in order to yield tax savings.